global perspectives on fintech, so I'm actually just putting this accent on for you guys. Only jokes. You're going to be hearing a South African accent, an Australian accent, a American-Irish accent, and I don't want to challenge what Shelly's accent is.
American.
Awesome. I've got an amazing panel in front of me right now, but really what I wanted to do is wonder if you guys have been listening to all the different fintech conversations, listening to all the different perspectives, and really my big question is, are we in the middle of a joke? Like, this fintech thing, is it not just a tech thing? Is it not a digital thing? Is it not just a transformation thing? So the way that I'm going to kind of tee it up is 3 people walk into a bar: an investor, a banker, and a fintech. And these 3 people are having this amazing discussion, and they're getting so excited about this opportunity. And the idea is that people have got excess airtime and credit on their phones. Everyone's going mobile. Everything's digital. It's pretty awesome. And the idea is, if I've got excess credit on my phone, can I not send it to someone else's phone? So the investor's going, I'll invest in that. And the banker's going, I'll use that. And the fintech's going, I'll build that. The joke is that that is M-Pesa. And that happened in 2007. And we're a little bit further down the line. And we are sitting here in the US looking at Silicon Valley, and we're looking at a whole bunch of these different startups and this boom in investment and all the money that is going into it. And the question is, but does not a lot of this already exist? Are we just throwing money in a direction just to keep ourselves happy? Is it real? Where's it going? What are the implications? And especially, what are the role players, like the fintech, the investor, and the banker? What do they have to do? So I've got lots of questions, and my panel has lots of answers. So starting on the end is Margaret Hartigan. She is the fintech that walked into the bar. Margaret?
That's right. Thanks, Thomas. Thank you for having me, and thank you to Deloitte and Singularity for having me. I'm Margaret Hartigan. I'm the co-founder and CEO of Marstone. We're a digital investment and financial planning platform that we make for incumbents to respond to innovation, frankly. So if it's robo-advice, financial planning, and whatnot, we create platforms that are enterprise-worthy in industrial strength that they can respond, do their own private white labeling, et cetera, et cetera.
So, and the banker sitting next to Margaret is Mark Hand. He'll talk slowly with his accent if people can't really understand the Australian accent, but he promises to repeat himself and make himself understood.
That's kind of rude, really. My name is Mark Hand. I'm the traditional banker. I've been 29 years with ANZ. I used to run the retail business, and I now run the corporate commercial business, which is a large wholesale bank business, from the smallest businesses through to the biggest corporates in Australia.
Awesome. And thanks for making it all the way. So I'm making fun of him because he made a real effort to come all the way from Australia for this panel. And then we have the real-life investor from Silicon Valley, Shelly Kapoor.
Hi, Thomas. Thank you. Thank you for having me here. Again, I'm Shelly Kapoor. I'm founding partner of the Shatter Fund, and the Shatter Fund invests in female-led or founded technology companies, and my 3 areas of investment are health tech, fintech, and ed tech, and then some opportunistic investment as well.
Awesome. Thanks, guys. So, global perspectives in fintech. So I want to kind of launch into, let's put the global in fintech and really get to the bottom of, maybe from a US perspective, we are pretty myopic here in terms of the level of investment and the level of innovation that's taking place. We know that M-Pesa has been around for a long time. And we saw an announcement yesterday that is going after Venmo, which is this amazing payments fintech, but in actual fact, it's replicating what M-Pesa did, right? And so the question, and maybe I'll put it to you first, Mark, is what are your thoughts on the level of innovation and the level of fintech activity, let's just call it outside the US, in Australasia, Asia, etc. What are your thoughts and what do you see relative to what's going on in the US, per se, perhaps?
I'm not sure it's radically different, but the scale of what we're seeing around the world is staggering. So we started, I guess, down this path probably about 2 years ago, where we stopped thinking that fintech was a threat, and we realised it's probably the biggest opportunity that we've seen in my career. We've got a bank with licenses, distribution capability, millions of customers, and here's a group of people that are solving our customers' problems, so we don't have to worry about solving them. So it became obvious that it's the perfect partnership. And once we sort of opened our eyes to that, and then we went into a few partnerships with some of the fintechs and started to launch some of the capability, people started kicking our door down. Once the market believed that we were open to the opportunity, that it was an opportunity, not a threat, we started getting offers left, right and centre. So I would get daily, I'd have people contact me with ideas, thoughts from all over the world. There's a lot comes out of Singapore. We see quite a bit come out of Israel. The UK is quite strong, but we see a lot coming out of the US as well. And part of the reason that I'm here was to visit some of those people that have put some really interesting ideas in front of us.
So Shelly, question to you as an investor in fintechs is, so Mark says the ideal partner. You as a VC investor, are you looking for your investments to form partnerships with incumbents, or are you looking for them to become the unicorns and to fundamentally change the game?
So I think that's a really good question. And to Mark's point, it's not a threat, it's an opportunity. And so therefore collaboration and collaborative partnerships are going to be really critical for legacy banking and for disruptive fintech companies. And so, for example, I would say that if you think about, if I can just use AI as an example, banks are, in the next 3 years, I think it's like something like 76% of bankers believe that artificial intelligence will be used primarily in how they interact with their consumers. Having said that, the biggest challenge is going to be how are they going to implement and how are they going to go to that digital enterprise that uses that AI. So I think that there's a real opportunity to bring the two together, but it's going to take collaboration and partnerships.
So do you chase the technology first as a theme, or do you chase the business issue that is not going away?
So, the technology has to solve, it depends, right? The technology has to solve a critical issue in the market. And as an investor, of course, I look for the tech platform first, but the market has to be there.
Excellent. So, Margaret, you have an awesome business. I mean, you have got a business that has gone gangbusters in the form of Milestone. You are kind of the poster child of all of the things around automation and the kind of the no-brainer investments that are being undertaken. Mark's point around partnership, you are hitting the market still at a very early stage in your business life cycle. You are forming those partnerships. How is that actually working out for you?
Well, thank you for your kind remarks. It's working out really well. Before I started Marstone, I was a financial advisor for 10 years at Merrill Lynch, and I was client-facing during that very tumultuous period from 2001 to 2012. And so I was with clients during the highs and lows of the markets. And for me, every account was a personal narrative. And I thought that the way we were going to do business would never be the same, that we would see someone come into financial services for retail investors, very much the way we saw Priceline and Orbitz come into travel, the way we saw Apple demystify technology and make it all about user engagement, and then the way really Amazon created an interactive platform and helped people consume better. So, but having been an insider, if you will, I knew that the way that we would be successful is if we made it frictionless for institutions who wanted to adopt. And the reason we saw that was we knew that most financial services companies run on old legacy systems. So they might have a nice GUI for the desktop for the banker or the financial advisor, but underneath it's going back to a machine that's from the 70s and 80s. So rather than getting into a religious war, if you will, about adopting my technology versus your technology, we thought, let's go to a central hub of activity that many, many clients draw from. And the first strategic partnership we did was with BNY Mellon Pershing. And that really added a lot of ease and automation for anyone who wanted to adopt the platform. We've since done partnerships with Fiserv, Quovo, and also other people who are helping us implement and integrate. So for us, we believe in innovation. You know, the US market is highly regulated, so it makes it quite difficult for innovation to be widely adopted. We tend to be fear-based. And so I think it's a while before we see the true disruption that people may have thought that we were going to see a few years ago. So again, we try to make it frictionless. And fintech's a broad organization or a broad term because wealth management is very different than payments or other things. So we're not seeing quite the adoption on mobile first yet for it. So you have to integrate more to the desktop, the tablet, and other structures. And the last thing I'll say is that when it comes to wealth management and investment, that usually happens because someone's made a recommendation. Wealth management is still an industry that's sold, not bought, and people look for a lot of guidance. So the idea that you were just going to build it and they will come, we thought that was going to be a harder road to go.
So there's quite a lot in there, and really, it sounds like you spend a lot of your time informing and educating the partners and the people that you actually are going to solve the problem for.
That's right.
But that's not your business model, right? What
I
you
don't
want to
get paid
do
for
is
it.
you want to grow and scale your business.
Right.
So what would a typical interaction be with the different kind of business where Mark is sitting there saying, I need partnerships with fintechs, and you are a fintech saying, I need partnerships with banks. How does that interaction go, and how efficient is that process?
Well, we were very diligent and quiet in our approach. So we spent over more than a year and a half educating certain big strategic partners. I mean, it was a big learning curve for them. They too felt incredibly threatened, as Mark said, that are we there to disintermediate their clients who are RIAs or broker dealers? You know, I was a financial advisor. My father is still a financial advisor, as is one of my brothers. We didn't create this platform to disintermediate or even disrupt. We actually did it to complement, automate, and scale. But the industry is catching up so quickly. So what they used to think as threats, to your point, they now see as important partnerships. They know they can't innovate fast enough, but the innovators can't backfill those core technologies and processes either. So we always believed that we were less interested in disruption. We were far more interested in innovation and transformation. And the only way that was going to happen is if you got best of breed in complementary skills, whether it's custodian or payments or whatnot. So now it's moving quite quickly because the big issue is, can you get your speed to market and the success of your deployment and execution? That's the biggest risk that banks look for, I think, at this point. Do you agree?
Yeah, I agree. There's a reputation that comes with it, so it's the execution risk and the reputation risk that comes with dealing with the wrong people.
Well, and also a lot of this, robo is not the right word, but it's digital advice or platforms. That's table stakes now, because what you're seeing on the front end, it's a convergence of all things financial services engagement, whether it's banking, credit, lending, and the client isn't interested in the limitations of the bank's back-end vendors. They just know what they want.
Yeah, and again, just coming back to the interface between you and, like, you just talk, the innovation is just flowing, but if Mark is sitting there and he's listening to this, because he gets, maybe you can give an example, gets calls up all the time of fintechs and everyone's saying, oh, well, this is how it's going to work and this is how it's going to happen. Mark, how do you actually make the choice as to who do you go with, and what are the actual implications and terms that you move forward with when someone like Margaret arrives at your door, and you can see the future, but how do you actually get it going?
Yeah, Margaret makes it sound quite easy, but it's not. I feel sorry for the first couple of fintechs that knocked on our door. They had great ideas. I remember I had a coffee with one guy that had a really good solution around KYC, and it was something I thought was well worth a pilot. So we had a coffee, he pitched it to me, I liked it, and I said, we'll go ahead. And then, unfortunately for him, I referred it to our legal and sourcing department, and then the process started from there, and they land these massive documents on his desk, and he calls me and said the legal fees were worth more than his company was worth. So what was the point? And we sort of learned pretty quickly that we're good at buying and selling banks, but we're not good at understanding the value that sits behind some of these startups. It's just not our core competency. So we go outside to have people help us do that. I tend to... I hope there's no one from my bank here, but I tend not to go through the sourcing and legal department. I just go to an external law firm that's actually good at this, and helps us see the value and does all the work for us, and we sort of bypass our internal processes, and it's a much more streamlined process that we have. But it all starts with a conversation around the idea in the first place, how robust the technology is, and they can demonstrate that. It's how advanced they are. Most of the ones that we've done partnerships with are actually profitable in their own right. They've got traction in the market. They're starting to get somewhere. So it's less of a risk for us. Just yesterday, I pulled the pin on one. It's a great concept, but they just can't deliver on it. So we've had to pull the pin on one yesterday. Fortunately, we hadn't announced it to the market. But as we've learned some lessons as we dug behind the scenes overnight to work out why they didn't get to where they said they could. And so we're still very much learning, but I don't pretend that would be easy to deal with yet. We've still got further to go.
So when the company comes to you, you're looking for a minimum amount of product market fit that they've already achieved, or what are the basic criteria?
So one or two of them have had no market penetration,
Okay.
but the product was complete. So what they developed was a working solution that we could run on very small scale. A couple of the more successful ones have had customers on the platform working well, and they were running a profitable business, and they were looking for scale, which we could bring to the table.
Isn't that an opportunity for an investor? So if that startup, first prize is customer number one, right? Customer number one being ANZ, that's pretty awesome. From an investment or investor VC perspective, Shelly, is that not a trick that's getting missed by the venture community, in that these fintechs are going direct to these entities and potentially blowing up, when in actual fact they just need a little bit of runway and a little bit of support around dev, etc. How do you handle that? Is that something that concerns you? Or you wait in a fundamentally different, or you invest in a fundamentally different domain in terms of maturity of entity?
So speaking for myself, the reason I asked Mark the question is I look for companies that have achieved product market fit. So we invest Series A, pre-Series A to Series B, so not too late, but somewhere in the middle there. Do I see it as, you said, is it a threat, or do I see it as a missed opportunity?
Yeah, it's a missed opportunity for these ones that
are going
might
directly?
be Series A, but they've actually got the client.
No, I
There's
don't.
a market need.
No, I don't see it as a missed opportunity, and here's why. I think that in 2016 alone, there was, I think it was $23 billion that was venture invested into fintech companies worldwide. And I think in Q4 of 2016, it was $4 billion. In Q1 2017, it dropped slightly, but I attribute that somewhat to the presidential election in the US. And so I think that the venture funding that's been invested into the fintech market is very critical. I think that fintech cannot thrive or survive without the venture community and the backing that we bring. I also think that the bigger threat is, for example, in banks. Banks are also innovating internally, and so they may not always choose to go to a fintech company. They may choose to be more nimble and agile on the inside, and what that means is you're developing the solution with your customer, but you're doing it banks are doing it in a bubble, and so that is more of the missed opportunity to me. That lack of collaboration. So from a VC standpoint, I feel pretty comfortable.
So just coming back to my metaphor of a really rubbish joke, are we actually just nibbling away at really what needs to get done here? If you look at the scale of investment, you mentioned scale, Mark, so take lending. SoftBank just invested $1.5 billion to go and support Paytm in India. So that's $1.5 billion. SoftBank just raised, what was it, like almost $100 billion fund.
$93 billion.
Yeah, so this is investment at an inordinate scale. And so when we look at fintech investments, early stage, is that really where the smart money is going? Or are there things that we potentially just need to let roll a few cycles and then look for the real opportunities beyond?
To
you.
Okay, thanks. So I think that, to the point of SoftBank's Vision Fund, it's a $93 billion fund that is particularly earmarked for AI. Okay, it's fintech, but primarily AI, and I think that in itself is very telling. And if you look at the chairman and CEO's comments, I think it was last year around where he sees the future going, he said, "I'm very focused on super intelligent robots." I think is what he said, right? And so, if you take Margaret, what you're doing, and then you put the AI, the intelligence on top of it, where it's able to assess your consumers' emotions and make predictions off of that. That's pretty powerful, and I think that's where we're going to see the trend going.
Yeah, it's big scale. And I think, well, a question to you, Margaret, is there perhaps an identity crisis, which is, we talk about fintech, and we talk about insurtech and regtech, and we're waiting for the next kind of tech. Does that label matter to you? Is it important to you? Or do you believe that it actually constrains you in terms of the business that you are looking to build, scale, and achieve the vision that you have for Milestone, for instance?
I think a robo-advisor would be more of a misnomer that is very narrow and something that we never saw ourselves as only. Fintech, I think, is great. I mean, it's a recycled term. I mean, there have been financial technology companies forever, and some of them are, companies of long standing that continue to innovate at quite a clip. I think the idea that only young, new companies are the ones that are going to be transformative, I think it is wrong. I'm pleased to be part of fintech or technology in general. I don't think it's a bad term. In terms of identity crisis, I think it's a great merchandising opportunity to hype big stories and to draw big dollars and things of that nature. But I think it's a massive arena, and so that's where I think things get lost in terms of suddenly all things fintech. No one really has domain expertise amongst all the areas of fintech. I certainly don't. I'm not an expert in blockchain or Bitcoin or any of these things, but I'm really good at what my silo is. And I think the opportunity is, are you creating great ecosystems, great platforms, and then can we even collaborate amongst other fintechs, right? Because it's happening so quickly that you could fall prey to just being a widget. And coming up with something new, identifying and proving it as a market, and then having incumbents develop it or other people copy it and just stuff it into their platform or ecosystem.
So Mark, over to you now, because this just sounds hard. It sounds complicated. There's a whole bunch of new risks. You're not sure if you should be putting your money on this. So why does fintech make sense to an incumbent who absolutely has all of the domain expertise, but equally has all of the visibility of the pain that potentially fintech might solve?
So I think we have all the expertise, but we don't necessarily have the capability. So for us to develop some of the things that we've launched, some of the platforms that we've launched, sort of concurrent services to banking, we could arguably build it, but big banks don't have, ours certainly doesn't, have a great track record of running big projects and delivering them anywhere near on time, anywhere near on the cost that it's set out to do, and anywhere near the scope that it's set out to have. It's always a de-scoped, over-costing exercise that doesn't quite deliver. So the first one that we partnered with, I started talking to in October, and we'd launched by March to the market. And we've now got tens and tens of thousands of customers that have flocked to this platform and starting to use it. And it's just been skinned like our bank, and they think it's our bank, but it's cost me about $700,000 in referral fees. And that's all it's cost me. And I've got tens of thousands of customers who have opened bank accounts on the bank.
Can you hazard a guess of what it could or might have cost you?
Oh, it'd be horrified. So I had a quote from my technology department, because that's the way banks work. You go to your own technology people and get a quote. And the original quote was $8 million. And by the time we got to a point of thinking maybe it's something we should do, the quote was at about 12, and it was on its way up. So I would have thought it would cost us 20 million and then not do what it needed to do. And in the meantime, this startup would have launched with another competitor, and we would have missed the boat.
Mm-hmm.
I mean, that's a big delta.
Yeah,
right?
it's massive.
I mean, Margaret, you got experience in terms of trying to find the Mark version with the partners that you have. Mm-hmm. Do you feel that you are making traction? What is working? What isn't working?
Absolutely. I mean, one of the nice things about the way that we've done core integrations is it really focuses everyone's attention, whether it's a certain custodian or it's a back-end banking technology, and that limits the number of people that are inputting because the rules of engagement are already set by what the technology is. But technology is rarely the problem for these organizations building it. It's exactly what Mark said. It's the people culture, the politics, the fear of making a decision. Oftentimes after the decision makers have picked a vendor, it gets then assigned to a project manager who maybe doesn't have experience with all the different workflows, work silos of the organization, doesn't have the gravitas to hold different units accountable, and certainly doesn't understand its vendor relationships. And that's where it would be really interesting to see what the opportunity costs were and the actual dollars spent by maybe not even getting like a Deloitte on some of these big enterprise sales involved. Because my whole argument has been, you don't buy Salesforce or SAP and Oracle and plug it in. So why are you going to necessarily have different fintech deployments and think it's going to be plug and play? It's actually the people capital and the workflows and all the boring and tedious stuff that actually slows these projects down, in my opinion.
So I guess a question goes out to the incumbents with the innovation labs and the incubators and the accelerators. Shelly, over to you now. Are these labs and incubators and accelerators, are they helping you as an investor, or are they potentially a competitor because they are looking to buy what you want to be buying? But if Mark says some of the characteristics that Mark just explained, whether they are unique to ANZ or lots of other banks experience the same issues, is that not a problem for you in terms of the incumbent is investing in an entity that you can really make a difference with, but they're not getting the return and they're not getting the traction? Is that an issue for you guys?
I have to say, so far, before I answer that, I'll tell you my experience. So far, my experience has been that, larger companies, whether it's a major credit card company that wants to be a technology platform, or even a major bank, have engaged us, my fund, to actually be their eyes and ears on the outside to tell them what I'm seeing in Europe, what I'm seeing across the U.S. in terms of fintech, and whether that's payments, whether that's AI, whatever different lending platforms, because they don't have the wherewithal to go find those deals. So for us, it's been kind of an opportunity because then these companies have invested in our fund off their balance sheet, the ones that we're helping be the eyes and ears for. So I haven't seen it as a threat. And again, I think to Mark's point, there's so much deal flow out there that it depends. There's so many factors that go into it. A company that's in an accelerator, maybe they need to be there, that's fine, but I can find 3 or 4 other companies that I can invest in that meet my criteria, that don't belong inside a MasterCard or don't belong inside of Capital One's accelerator. So I have the deal flow that I need.
So Mark, are you a buyer? Are you a borrower, a renter of these fintechs?
So I would say we're either, I think it was, someone said it this morning about, I think it was Brett, about we're either going to partner, we're going to buy, or we're going to build it ourselves. Reality is, I think we'll partner 95% of the time. There is one that we have that I'd love to buy because I can think of what else we could do with it. They think they're worth 100 million. We think they're worth 25 million. So
you've been talking to Margaret.
Yep. So we are so far apart that we still can't understand how they get their valuation, and they'll quote companies like Uber about how they do valuations, and we don't know why Uber's worth that much. So for us, it's most likely to be a partnership. But every now and then, there's a couple out there that I think are probably going to be worth the punt. And particularly if we get in early, there's one that a staff member, we had a guy working part-time in our tech department that built something on the side, and it's great, and we'd love to buy that. And he's asking a very reasonable price for it, and we'll probably go ahead with that one. But we're very much in on the ground, and it's a small bet.
Okay. And I guess just from an organizational model, so you're going to acquire these guys, or you partner with these entities. What do you have to do differently internally to make that a success?
I think we just need to get out of their way. So we can sit down with them and agree the customer experience and the problem we're trying to solve, and then we just get out of the way. So they invite us to and show us their latest prototypes, and I make a point of telling my people, don't ask too many questions, and certainly don't offer any advice, because the last thing they need is a 29-year banker telling them how to design a great customer experience, because that's not what we're good at. So we listen to them. We don't say too much in the meetings, and they tell us what they're trying to do, and we just satisfy ourselves that they're addressing what our research says are big customer pain points.
Shelly, you come from industry. I mean, sorry, referring to Margaret. You come from industry. You have sat there in the world of wealth management. You came through the financial crisis, and you've now created a business that solves something that you couldn't believe was just not being solved. What else do you believe is like the biggest no-brainers that are existing inside organizations, but they are not moving to look at fintechs more, to double down on fintechs, to partner more? Let me pause there for that question, because you've gone to the other side because it's just massive, massive need, but still not rapid enough connections and scaling. Any comments on that?
Marstone was set out to address three major challenges. The first one was financial literacy for individuals, investors, because I realized during 2008 that didn't matter how sophisticated someone was or how affluent, they really lacked financial literacy and didn't understand the correlations of different investments and what that could mean to their life goals. So again, not that they're not bright, they just didn't have, in the US, we don't have exposure to this in curriculum or what have you. The second one was for financial advisors. We're in the midst of this incredible wealth transference between World War II baby boomers, Gen X, Gen Y. And you'll see that in the wake of 2008, the banks kind of got rid of their training programs. Young people coming out of university and business school didn't want to go into financial services. And the average client when I was at Merrill was 66, so that's 5 years ago, and the average advisor was 55. And so we didn't have a way to keep our arms around our core clients' errors, so that when you look at the Capgemini reports and whatnot, when you see the attrition that these firms are dealing with, when there's inheritance or life events, it's astonishing. I think the biggest challenge for the institutions is client retention. And then for institutions, how do you grow and scale? So believe it or not, it's completely ungroovy, but just the automation that the industry doesn't have. For instance, many firms in the US don't have the ability to electronically onboard a client and do e-signature. I mean, if you think M-Pesa is a bad example, I mean, it's really, really bad.
I understand faxes are more secure. So you need to find someone
that's
find
right.
a fax
You have to
machine.
find one.
Yeah.
You have to find one. But that's really true still. So it's not that, and then just better client engagement. One, a senior person at Merrill once said to me, "Well, you figured out something we'll never figure out, and that is, you figured out how to speak to our clients without a human being, like in human terms." So, we throw terms like convexity and duration and Sharpe ratio on the wealth management side to clients. Well, you don't go see your doctor and have him start speaking to you in chemical compounds and whatnot. So the disconnect between the industry and how they speak and how they manufacture goods and the consumer and what the consumer is trying to achieve, there's a huge chasm. So some of it's just a matter of design, and then some of it's just the operational bridging that needs to happen between innovation and the core systems that run it.
Awesome. I mean, so we live in a very interesting time, and just with this event, we've seen a massive transition in fintech and investment just over the last few years, of especially exponential finance. In the few minutes that we have left, I really want to try and get the audience to tune into you guys in terms of what a possible end game might be. Margaret, you once mentioned to me, I think the term you used is there's a mirage of time. Like they've actually think they've got enough time and enough choice. They don't have any time. They don't have any choice. And so the question is, from an investor, a banker, and a fintech, what's going to give and what's going to accelerate? Is it going to be more investment in more fintechs and therefore more ecosystem maturity? Or is there going to be more reorganization in a bank that can metabolize fintechs and you technically be the equity investor as opposed to the financial investor? So I'll just open it to any of you to maybe respond on what a potential end game is, accelerate, decelerate, where the money's going.
You know, one thing I'll say is I don't know that it's an end game. So, for example, even with how saturated the fintech space is in terms of payments, right? There are still new disruptors that are trying to come in and competitors that are trying to come into the cashless space, right? That's number one. So, but I think having said that, despite the saturation we think we're seeing, I don't think we've even scratched the surface of the next generation of products in the fintech or innovation in the fintech field. That's number one. I also think from an investor standpoint, like I said earlier, there were nearly $23 billion of venture worldwide invested in fintech, and that number went from $4 billion in Q4 to $3 billion in Q1. I think investors are at a point now where they've put their money in and they want to sit back and see what happens to those investments. So I think that's where we are. So I don't think we've scratched the entire surface yet of where we could be, and I think for the time being, investors might start to slow down their investment.
Okay. Mark, what are your thoughts?
I think the partnership model is going to accelerate to a whole new level. I know there's 4 major banks in Australia and a bunch of small banks, and so we're a bit of a protected market in that instance, but we all look the same. All the banks look the same from the outside. I think we'll choose slightly different strategies, focus on different areas. We'll accelerate through the use of partnerships, because it's going to be a long time before we can learn to work at a company of our size, like a Google or an Amazon, to be able to work with that agility and that pace. I don't think we have an option but to find more and more partners to help accelerate, and otherwise we will have people come in and steal our customers and do other things with them. But I think we can still win if we take the partnership model, but it's got to really ramp up in pace a lot more.
And there's some tough choices and trade-offs.
Yeah.
Can I make one comment to
Yeah,
that?
sure.
And in fact, last year there was an increase in the number of fintech solutions targeting B2B as opposed to just B2C, and I think it went up by 10%.
Yeah.
So it was something along those lines. So you're correct.
The focus has been heavily on the
Yes.
consumer market. It's now turned its attention to the commercial market, so we're seeing great opportunities out there, much faster than we could ever get round to it.
I mean, that's actually quite interesting, and I didn't expect it to go in this direction, because what you just said and what Margaret said earlier around we as a fintech engaging with an incumbent as a partnership, but then also to partner with other fintechs. So that's an interesting dynamic where the external partner is creating the network and the connections to connect to an incumbent.
Absolutely.
Do you see that as something that's going to manifest more, Margaret?
Definitely. I think the term co-opetition is one that's used a lot, and I think that's totally appropriate. We're not in a binary world of incumbent bad, innovator good. I think that the last few years have demonstrated that's not working, at least in our category. But I also think that you're going to have very deep domain expertise. So especially in the case of AI, there's not going to be a magic widget that comes out of any of the big technology companies that are AI, because there's so many unintended consequences of just applying, a pure machine learning device, especially in the case of wealth management or banking or transaction. But if you partner with a firm like Marstone or other wealth management firms, AI is only as good as the quality of the data it ingests and the practitioners who are teaching it. And there's a real way, if you collaborate with, a company like Mark's, where we could be a huge accelerant for that, and that can be quite powerful. So I do think that Mark's right. I think that we're going to see tremendous amounts of collaboration, and that's really the only way. I don't know that there's an end game per se, although I do think that you will see other players entering into the space that you wouldn't have otherwise thought about.
Awesome. Well, it's been an absolute privilege to have you guys on stage. I have learnt a lot. I'm sure the audience has too. So I'd like to thank you for making the time, making the effort, getting on flights. And everyone can find you later, because you are here for the remainder of the conference.
Indeed.
Thanks very much. Thanks, everyone.
Thank you.